Hi there, folks. Hey, it's tax time, so we're going to talk about indirect rollovers. We're going to talk about direct rollovers. We're going to talk about direct transfers. What does this have to do with tax time? Because I promise you, once upon a time, if you've been in the business for any period of time, a client has come to you and said, hey, my CPA says we should have had a 1099 sent out on this. On that transfer we did last year. Well, no, because it was a direct transfer. The client goes back to the CPA, client comes back and says, well, the client says whether it was a direct transfer or a rollover, well, they're basically the same thing. There should have been a 1099 sent out. That's when you say back, no, we did a direct transfer, which is different than a direct rollover, which is also different than an indirect rollover. And direct transfers do not have 1099-Rs generated. So tell your CPA, well, I won't go there. But anyway, that's the type of stuff that we're gonna see around tax time. I see this all the time. So we're gonna talk about indirect rollovers, direct rollovers, and direct transfers. Getting all excited over this. So what is an indirect rollover? Let's say I have $100,000 at a 401k. A principal has the 401k. It's an old employer, let's say $100,000. I can say, hey, I love this Corebridge annuity over here. I want to move that money from the 401k over to this, which turns it into an IRA, right? And I want to do that. You know, I'm separated from service. The 401k rules say that I can do this, blah, blah, blah. So what can I do? Well, number one, I can do an indirect rollover. And that is when I tell the company, you know what, just write me a check. Just write me a check for $100,000 payable to Charlie Gipple. Write me a check. I get that check. I deposit that check. And if I want to not effectively cash out that 401k plan, pay taxes on it, pay pre-59.5 penalties because I'm 46, I'm not over 59.5. What do I need to do? The IRS says that with indirect rollovers, you've gotten access. You have constructive receipt of that money when you cash that check. Within 60 days, you have to write a new check to an IRA company, Corebridge, annuities, for example, and that will basically undo the tax liability. Now, there are a couple of things here that I want to talk about, a couple of very important things. Number one is there a 1099-R generated from that indirect rollover? Absolutely. What if I never deposit that money? The IRS should have reporting that I cashed out $100,000. So that's number one. Well, okay, Charlie, then how do we not get taxed at the end of the year if you actually did roll it over to an IRA? Well, that's where the insurance company will generate a 5498 that basically says, nah, that money rolled over into this new account. So it basically washes away the 1099-R, so to speak. But you still need that 1099-R for tax reporting time. Keep that in mind. But number two, in my example, did I get a check for $100,000? Did I actually get a $100,000 check payable to Charlie Gipple? No, because it's coming from a qualified plan. A qualified plan to an IRA says that there's a mandatory 20% withholding because they want to make sure that Charlie has the cash at the end of the year if I never did that second step in the rollover to where I can pay that, whatever, $20,000 tax bill. So there's a 20% mandatory withholding from qualified plan to IRA. Now, what about an indirect rollover IRA to IRA? Is there a mandatory 20% withholding? No. So if you have to do an indirect rollover, which I don't recommend, indirect rollovers can be dangerous. Virtually 100% of the 60 million bucks that our company did last year, well, of which probably half of that is qualified money, I would say are the second category and the third category we're going to talk about. Direct rollover and direct transfer, not indirect rollover. But I digress. Let's say the client says, I have an IRA. I want to roll it over to another IRA. I love that Corebridge annuity you're talking about, and you recommend an indirect rollover. That client gets the check. They deposit it into their account. Was that check subject to that 20% withholding? No, it's not. The 20% withholding applies to qualified account to IRA, not IRA to IRA. But in both scenarios, there would be a 1099-R generated. By the way, that client would have to come up with an additional $20,000 out of their pocket if they want that whole $100,000 to go into American Equity or Corebridge annuity, whatever it is we're talking about. Otherwise, it's effectively treated as if we cashed it out. So if I'm less than 59.5, that means on that $20,000, if I didn't come up with that to make it the whole 100,000 bucks, pre 59.5 penalties, taxes as well. There's a lot that can go wrong with indirect rollovers. And you can only do one of those within a 12-month period of time with a bunch of additional details around that. So that's indirect rollover. Try not to use indirect rollovers when you can. Number two, direct rollovers. Very similar, right? So the 401k company writes a check and you get that check, or the IRA company writes a check and you, the client, get that check. But here's the big difference. That check is not made out to you, the consumer. That check is made out to the custodian for the benefit of you. Payable to Corbridge for the benefit of Charlie Gipple. You merely take that check and you forward it on to that new custodian. That is called a direct rollover. Now, that CPA, I get this all the time with these. Oh, there should have been there shouldn't have been a 1099-R generated because it was a direct rollover. A direct rollover will create a 1099-R as well. Again, when that check goes in the doors of that new company, it will basically be washed away, however, by a 5498. So any type of rollover, whether it's an indirect rollover or a direct rollover, you're going to have 1099-Rs that are going to come to the client. Some clients panic. Not a big deal if they, in fact, forwarded that check to the new company there. No 20% withholding, whether it's from a qualified plan or from an IRA, onto the new company, Corbridge, for instance. No 20% withholding with direct rollovers versus there is with indirect rollovers in that, qualified plan to IRA scenario. Direct rollover. So tactically, here's what happens a lot when agents are asking me, so I send in the application, Charlie, do we do the transfer form as well? Does a client do request that the money be made, that the check be made out to them? No. Here's what typically happens. Don't send in any transfer paperwork. Generally, this is what happens. Don't send in any transfer paperwork when we are setting up the new annuity, right? So you set up a new annuity on the application, you'll say it's a direct rollover. Yes, you will say that, but we're not going to send in any transfer documentations or anything like that. The policy will pass suitability, you'll have a policy number established, but it's unfunded. At that point in time, when I give you the go, is when we go to the 401k provider, and it can be very easy at times. Principal, for instance, usually principal, says, hey, just get the client on the phone. We can do this over the phone. Get the client on the phone. Principal says, hey, what's the new policy number? What's the address of that company? And they say, we're just going to send out a check to you, payable for the benefit of you, but yet to Corbridge, and we're just going to send the check out today, and you, the client, send it on to the new annuity company. That's what happens a lot. Or probably more times than not, that other company, principal, for instance, says, we need our own forms. So you go through all this transfer paperwork stuff and submit that with the application. You've wasted your time many times because many times, especially with qualified employer-sponsored plans, they require their own forms. That Accord form that is just what every carrier uses out there, that is usually not accepted. So why send in all that documentation if we can handle that once suitability is cleared and you have a policy number? Deal with that later. So anyway, that's a little bit of a tangent there, but direct rollovers, 1099s are created and there is no 20% withholding. Direct transfers are pretty simple. It's like a 1035 exchange. You tell the insurance carrier to request the funds on that direct transfer or 1035 exchange form. They request it from the other insurance company. That other insurance company or qualified plan sends the money direct, custodian to custodian transfer. And that's what a direct transfer is. Direct transfers don't even generate 1099. So clearly the two most popular options for qualified money is direct rollovers and direct transfers. The first one, indirect rollovers, try to stay away from those.